Let's start off with the 23 banks stress tested in a little bit of a different way than what we saw the last time all 23 passed.
Yeah, there's certain parts of the test that were obviously a little bit more stressful than previous years, but when all in all the banks had passed, pretty clean read. We have had years in the past where there are conditional failures or constraints on the banks, but the clean read is a welcome time this time around, given the stresses we've seen in the banking system. I will say we should talk for just a quick moment about the extent of the losses they faced.
Okay.
There are about $540 billion in losses that the banks faced under these scenarios. Most of those losses really came from things like loan loss provisions on credit cards. But you also did see there was an extraordinary market shock this time around. While the banks with the large trading desks have passed the stress test, the losses that they have absorbed are almost $100 billion in losses. So that shows you the extent of the losses faced by the trading desks alone relative to what you're seeing at the large credit card companies, for example, or other companies with large
So, I mean, not to poo-poo that, but is that a lot? I mean, because when I hear, you talk about 100 billion loss and then the 500 billion in aggregate here, I mean, I know that's a lot of money, but when you add up sort of the total banking system here, that's still a small fraction.
It's about less than a fifth. But if you think about it, it's such a small percentage of banks. We know that these are the behemoth banks. But if you think about $541 billion in losses and almost 100 coming just from the big trading desks, you decide, right? Beyond that, the reason that they're doing this is there's an expectation that while this doesn't really count towards any future capital constraints moving for this test, it could be a bigger deal for them moving forward. And that's why we watch it.
So just real quickly here, Sonali, normally when we get these stress tests, there's usually a flurry of headlines where all the banks announce, oh, we're going to raise this dividend or increase this buyback. Are we going to see that today?
So the Fed has asked the banks to wait this time around, and now comes the comments that come between the Fed and the banks. And so the expectation for the market is that most of these banks will start to announce by the end of Friday after market close. But you also have to think about the other constraints these banks are facing as well. They have already guided that with international rules, Basel III endgame, that there could be a sense that there's really a lot more on the horizon that these banks might face when it comes to future regulation that could really start to constrain capital. Romaine, I do want to also point out some of the banks here that have also met their minimum capital requirements in this stress test. And the reason I want to do that is because when you look at the banks that have met either the minimum Tier 1 capital ratios or the supplementary leverage ratios, you have a scenario in which you start to ask whether they start to raise more capital in markets, whether they go to the bond markets, for example. And so this is banks including, for example, for supplementary leverage ratio, that is UBS, that is Deutsche Bank, these are the US units, that is Truist, Capital One, TD. When it comes to the Tier 1 capital ratio, also a lot of the regionals and international banks, UBS, Truist, M&T, TD, BMO, Citizens, and Capital One. And so they met the minimum there. They passed, but they met the minimum.